war, we're not even 2 weeks old, and you've likely seen the impact at the pump, and the knock-on effects are just going to extend much further into your wallet. So we're going to break it all down for you today, and we're also happy to answer any specific questions you may have. Just drop them in the chat on YouTube or LinkedIn. I want to bring in executive editor and markets guru Joe Ciolli, who also writes our First Trade newsletter. And it's a big thing that Joe's here because it's a big week for his Fighting Illini. The Big Ten men's hoops tournament's kicking off today. So, Joe, I really appreciate you taking the time.
Thanks a lot, Dan. Really excited to be here. The Illini don't play till Friday, so I have plenty of time. So go Illini. Yeah,
I figured you wanted to do some scouting before, but appreciate nonetheless you taking the time. But before we get into it, I thought we could get assist from a special guest. So there's this show called Landman that's all about the oil industry in Texas. Joe, I know you haven't watched it yet, but I think Billy Bob Thornton's character does a great job of summarizing the issues that we're seeing with the oil prices in about 20 seconds.
You want oil to live above 60 but below 90. And don't get me wrong, we're still printing money at 90, but gas gets up over $3.50 a gallon, it starts to pinch. It hits 100, every product in America has to readjust its price. $78 a barrel, that's about perfect. You know, it brings enough profit to keep exploring, but it don't sting as much at the pump.
Yeah, so that's actually the show. We're just gonna leave it to Billy. No. So to Billy's point there, you know, we jumped way higher than the $90 a barrel barrier. Since the war has started in almost 2 weeks, it's kind of steadily gone up. But Monday, things really kicked off. We almost eclipsed that 120 barrier. Now things have come down. We're sitting right around that $85 to $86 a barrel as we speak, but we're still well above where things were before the war. And to Billy's point there, well above that sweet spot of 78. So, Joe, what gives with all this volatility?
Well, first off, I'm not sure I can explain it better than that clip did, but I will attempt. So the main reason for this is the Iran war, as you mentioned, and what it's done to crude supply and the entire global crude network. The main flashpoint that's emerged has been the Strait of Hormuz, which processes 20% of the world's crude oil flows, and it's essentially been closed. It's been closed for business, and that's a lot of oil sitting around, not getting delivered. So by the old equation of supply and demand, less supply drives that price way up, which is what we've seen. And if I would have watched Landman, I would probably already understand this.
I would say that, you know, Robert from Iowa wrote to me and he said, you know, guessing the trajectory of oil prices is like picking a number on the spinning wheel. So we have a hard job ahead of us. I will say I'm pretty good at roulette, so I don't necessarily buy that, Robert. But anyway, let's also talk about surpluses because we had the G7 pledge to release some oil reserves if things got pretty hairy. And then more recently, the IEA agreed to release 400 million barrels, which I think is double more than they've ever released before. Is this a bandage or is this a more long-term solution to this issue, do you think?
It's definitely a bandage. It does ease some concerns. When this started to percolate yesterday, right after they started talking about releasing these emergency stockpiles, we did see some price relief, a nice dip there. But we're up again today. Brent and WTI crude are both in positive territory today. So clearly traders are just waiting to see if anyone's going to actually follow through, whether we're going to get these releases. And it's also possible, just from a trading perspective, that a lot of the relief was already priced in across the big drop we saw on Monday into Tuesday. So a lot depends on, you know, when this happens, and you know, we'll see what the oil market does then.
Yeah, I want to talk a little bit now about something that I'm sure all of our viewers, me personally as a suburbanite, is concerned about, which is the price of the pump, right? So should we expect gas prices to move in tandem with these volatile oil prices?
I think yes, not exactly in tandem, but we have seen big increases at the pump since the war has started. There's usually a lag, and there's also some seasonal factors that usually take hold in this like late winter, early spring period that, you know, would push prices higher anyway, regardless of what happened in the Middle East. But I think that, you know, it's as simple as if the Middle East disruption lingers, the volatility at the pump will continue, and it's you know, these producers and the people that are selling it have shown that they're not going to be shy about, you know, passing that along.
Yeah, and when we say the people selling it, we should be clear, you know, like don't go after your local gas station operator. Like this is not their fault. They're not profiting off this. Like they're not minting money. So, you know, just go in and buy a Kit Kat and relax. Okay, so beyond gas prices though, this is a much bigger knock-on effect, right? I mean, the implications here are pretty large, really across the economy and a lot of things that we're buying.
Yeah, it's going to be inflationary, or it's expected to be inflationary all across the economy. The companies that use gas to power trucks, planes, machinery, they're all going to feel the pain, and they have felt the pain already in the stock market because of the prospect of that happening. There's also the fact that gas is a necessity. Like you mentioned, you're a suburbanite. You're going to take your kids to school, regardless of how much gas costs. You're going to go to the supermarket or whatever, and you're not going to adjust that part of your routine. Where you're going to do is probably start to pull back on more discretionary areas. So discretionary industries are probably at risk here. And some of the things that we don't need for our everyday life, might come at the expense of some of the more necessary staples.
Yeah, I mean, gas could be $20 a gallon. I'm not going to not drop my daughters off at daycare. That trip is being made regardless. I will mention, we're talking a lot about oil naturally because I think that's what people tend to think of in this region. But Davin from Australia also raised the issue of fertilizer supply. Roughly a third of the global fertilizer trade actually goes through that region. I don't know if you had any thoughts on the impact that's taking place there.
Yeah, a rise in fertilizer prices would really hurt certain industries, particularly farming and agriculture, possibly even more than a spike in oil. It would likely cut crop yields and drive insolvencies across farms. And honestly, most crucially to everyday Americans, it could push up food prices, and no one likes that. The avocados memed out a few years ago. You don't want to go to Whole Foods and your avocado's $6 instead of $5 now. So that could very well happen.
Cuts deep, as millennials, Joe. It cuts deep, those avocados, that avocado toast. We ran a poll, so I want to pull it up now and show you all. So over 5,000 of you responded, and the top response with 40% described themselves as very worried about the war's impact on the economy. So let's start there, and let's start with what I think a lot of experts are saying is the most immediate concern, which is the inflationary risk. So, and I also caveat this by saying we did get inflationary numbers this morning, but, and you can maybe explain this a little bit more, it's not really valid to the conversation because it's not including any of the recent situation in Iran. So kind of take that, set that aside, talk a little bit about what the inflationary risks are here, Joe.
Yeah, it's a huge concern. And energy and gas had really been a bright spot in the inflation picture for months leading up to this oil shock. And now, an area of relative strength is likely to become a weakness. That's, the area that's going to pinch the most is in the energy sector, prices at the pump. So that's not looking good. We mentioned food. That was, a weak part of the equation, and that's set to get weaker. So just overall, inflationary pressure is definitely top of mind. And we did get data today. It was for February. The war started late February after the weekend had already started. So we basically got no indication. So we'll have to wait until next month to really see.
Okay, I'm going to use a naughty word here, so maybe the younger viewers cover your ears. Stagflation, right? Very scary. Hear this mentioned a lot, especially bringing up the oil crisis of the 70s. What's your thoughts on, is there a real risk for stagflation? How nervous should we be here about that?
First off, I thought this was a family program. I don't know why we're saying stagflation, but anyways, it's a big tail risk scenario that's been thrown around. And it's basically inflation combined with sluggish economic growth. And it has a bad rep because it's actually worse than recession in many people's eyes, because when it happens, a central bank, its hands are tied. It cannot step in to save the day by cutting rates. And, we're really early innings here. It's not a foregone conclusion by any means, but a couple of those, it's a two-part equation, and both of those are moving in the direction of stagflation at the current time.
Okay, so we've talked inflation, we've talked stagflation. We're going to complete the holy trinity of inflations and talk about deflation. There's an argument that the labor market is so weak, wages have not risen, that basically consumers can't absorb these higher prices. What does that mean? What are your thoughts on that?
Yeah, I mean, and we know that inflation is bad, but deflation it can be just as bad. If no one is spending, companies can't grow profits, their stocks go down, no one wins, 401ks take a hit. And yeah, a deflationary spiral is something that can run alongside a recession or an economic downturn. And I'm sorry for saying recession. I know we're trying to keep it PG, but and I think that's probably too aggressive at this point, but it is something that does tend to accompany deflation. So it's something to keep an eye on.
All right, we got a little bit of a curveball here from the chat. Sandra wants to know about the car industry and just industrialization in general. Does it get weaker? I guess, cars, I mean, this is like very 30,000 foot view, you have gas prices go up. I don't know, people less resistant. That whole industry has also been impacted, obviously, by tariffs. So there's a lot going on there. We actually wrote a story recently about EV drivers kind of laughing it off. I think the quote was, "I didn't know there was an oil situation. I drive a Tesla." But Joe, I don't know if you had any top of mind thoughts about that section of the industry, or that industry getting impacted at all.
Yeah, I mean, I think that logic makes sense. The fact that EVs would benefit at a time when one of the major input costs for gas vehicles is rising. And I think that car companies are gonna have a hard time moving inventory when that's the case. And if people are pinching pennies, they might just rather than buy a new car, just stick with the one they have for a little bit longer than they would have. Do the math, take it into the shop a few more times. Save money that way instead of buying a new vehicle. But I'll just point out that oil prices were up above this, even higher than the 120 that we came close to in 2022, and we didn't really see the deterioration of the car industry since then. EVs were earlier in their life cycle then, but so it's not really an apples to apples comparison. But if precedent tells us anything, it's that even higher oil prices for a period won't necessarily derail the entire auto industry.
Okay, let's play a little worst case, best case scenario, and we'll go bad news first. What's going to cause oil prices to go even higher? What's going to make the market go back to what happened on Monday when we were touching on that 120 mark?
The Strait of Hormuz, I cannot stress enough, is the game. That is it. Like, if the Strait of Hormuz is not open for business, or at least inching towards being fully open for business sooner than later, like, we're going to see oil prices even higher. So from the U.S.'s perspective, they're running military operations to disable the things that Iran can do to challenge the safe passage of the strait, and also the U.S. has offered to eventually start escorting ships, insuring ships. That hasn't happened yet. There was a false mixed up about the U.S. having escorted its first ship the other day. It hasn't happened yet, but that's what you got to watch. It's the Strait of Hormuz, and if we can keep that clear, then the oil prices will likely normalize a bit.
Yeah, it really is interesting to see how that one specific reason just holds, literally a chokehold on this entire market. Andre also says that travel and tourism will shrink. I think that's a really good point. Joe, we talked about this in our morning meeting in the newsroom. The fact that it's just difficult, even from a financial perspective, but also from a logistical perspective. Flying over in that region because of some of the closed airspaces. We saw some situations in South America, obviously in Central America earlier this year. So I don't know, maybe it's the hot American summer this summer. We'll see. Flip side, optimistic. Let's say the war ends in a couple weeks. Does everything go back to normal? Is this from an oil market perspective? Obviously, there's a lot of changes that are going to be a lot more long-lasting from a geopolitical sense. But from an oil market perspective, is it just the economy just goes back to it was late February and we keep chugging along, or do you think are there some wounds here that are not going to heal easily?
It's going to take a lot longer than that for the oil market to revert to normal, and it could revert. It depends on what your definition of normal is. It could do so on a price basis, because of what global oil powers are able to do, the levers they can pull to basically push the price lower. But the disruptions to the world's oil logistics network, those are going to linger for months, if not years. And we have a pretty decent comp, the COVID era. I mean, I know that was a really long closure, but that started supply chains for literally years after, and this could be a miniature version of that.
Mm-hmm. Sure. We have one question here from Samer, and I know, we're mostly U.S. focused, right? But he kind of asks, what about the growing economies like in India? What should they do to survive the rise in oil prices? I'll just say, Joe, I don't know if you have any thoughts. I think it's always tricky. It just always feels like these type of price shocks impact those regions a lot more. There's, for lack of a better term, less margin for error in those parts of the world. But I don't know, Joe, if you had anything else. I know it's a little bit outside of your wheelhouse, but curious if you had thoughts.
Yeah, India has strategic reserves. It has, I think, 25 to 50 days of strategic oil reserves. So its government does have, I think it might have to do so in concert with the other oil-producing nations, but it does have a nice padding to fall back on. So I'm not saying that's going to solve problems at the the individual level, but in terms of what the input price is for the country, they do have that lever at their disposal.
Specifically to the U.S., there's also this taco element. So if you don't know, taco, the concept that Trump always chickens out, it became very popular around the time of the tariffs. The idea that as the market was moving in a way that President Trump didn't like, he would kind of change course. And there's been talk of the taco trade or some tacoing around the oil market, right? You saw that, Trump came out and said that the war was very complete. Ultimately, if you can't really taco a war, right? But it certainly seems like he's kind of trying. And is the market is there a taco trade element to this, or do you think it's a little bit trying to fit a round peg in a square hole?
We call it a temporary taco trade because the version did play out. It was kind of textbook. An asset, in this case oil, got really out over its skis, and then Trump said something publicly that caused a massive reversal. So that definitely is very taco tradey. But I will say that the difference between this, involving a war, and then tariff announcements, things that haven't even gone into effect yet, that's a big difference. So the disruption in the Middle East is much more complex than that. And the relief isn't going to last in the long term unless there's actual de-escalation progress made in the region. So whether that means clearing out the strait, like we talked about, or kind of winding down military operations overall, I think that's what the market's looking for, is just like a settling of tension and an elimination of the possibility that something could happen overnight to throw markets into disarray once again.
All right, last thing here before we let you go, want to leave the viewers with some investment advice, right? All of this going on, what can you do? Tom in New York, he's actually not worried about any of this, and he suggests buying U.S. airline stocks. I know a lot of them have maybe put on hedges for oil, so maybe or for their gas, so maybe they're not as worried. But curious if you have any overall strategies that the investors among us can look to apply to their own portfolio.
Well, I definitely respect Tom's willingness to buy the dip in airline stocks. They've gotten hit really hard. They're part of a group of companies that are really vulnerable to oil market volatility. Airlines actually used to fuel hedge, and so against price spikes, but they stopped doing it. So they've kind of been flying without a safety net there. But yeah, that it is down a lot. There may be opportunities there if there is a bounce back. We did see that in the COVID era. You remember the transportation stocks got destroyed, and then we had that big reopening trade where the cruise lines and the airlines really dominated and ended up even above where they were before. So yeah, that's one area. More traditionally, like you could go into energy stocks. That's the oil producers that directly benefit from a higher price of oil. There's also the safe havens that you have. There's gold. The U.S. dollar is a popular one. If you want to stay in currencies, the yen is a really popular reserve. And yeah, and I think like the ultimate investing tactic is just aversion. Just get out of the risk assets that are vulnerable to every last headline in the Middle East. And so yeah, that would be a good investing playbook, I'd say.
Joe, when there's blood in the water, you got to strike. Come on, the sharks among us, right? You got to attack when things are down. Well, listen.
Yeah, I respect Tom for saying that.
Appreciate you taking the time. First, I want to thank our special guest, Billy Bob Thornton, for joining us. It was great to see him. And then, Joe, I also want to thank you for joining us, and best of luck to your Illini.
I really appreciate it, and best of luck to your Jets here in free agency.
Gino's coming home. And yeah, with that, thank all of you for joining us. Until next time.